Hey guys, it is Julie here with JT Wealth. In today's video, we are taking a look at 3 undervalued stocks that have a lot of room to grow. So let's get into it. Alright guys, welcome back and thank you so much for being here. Like I said, today we are taking a look at 3 monster growth stocks that are still undervalued. So these 3 companies were just recently highlighted in that TipRanks article. So in today's video, we're going to take a bit of a closer look at what each of these companies do and what analysts are predicting for their stock's future. And just before we get into those 3 stocks, this is just your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and leave your thoughts in the comments down below. Also, don't forget to check out some of the great links in our description, especially if you like free stocks. Right now, Webull is giving away 2 free stocks valued up to $1,850 just for opening up and funding a new investment account. So make sure to check them out. All right, now let's get right into these undervalued growth stocks, starting off with a company called Kalera. Kalera trades under the ticker KLR and is currently at $16.21 per share. They are a trusted communication platform as a service company, and their platform helps you to engage with your clients with personalized messages, chatbots, programmable voice services, and more. Their platform boasts over 3,500 global customers with over 300 employees worldwide, and their Q3 2020 data showed about 6.3 billion messages and 1.1 billion voice calls. Over 75% of their revenues came from customers which have been on the platform for at least 1 year, and over 56% of revenues are related to the top 10 customers with a churn rate of 0 in the last year. They are trusted by some big names in the market such as Uber, Flipkart, Zomato, and Hyundai. Their platform provides secure communication solutions for multiple industries, such as their two-way messaging, their OTP or one-time password verification, and click-to-call for travel apps. The CPaaS market is expected to reach $25.9 billion in 2025 from just $7.2 billion in 2020 for a nearly 30% compound annual growth rate. And we've already seen great growth in Kalera's revenues as well. The company's third quarter results hit $38.3 million, which is the best since this stock went public. While Kalera still runs a net earnings loss each quarter, their Q3 earnings per share was the lowest such loss in the past 4 quarters. And we are set to hear their 4th quarter and full year 2020 results on Tuesday, February 16th before the market opens. One analyst covering this stock is Maxim analyst Alan Klee, who is bullish on KLR, seeing recent growth and product offerings as indicative of future performance. Over the past few years, Kalera has posted double-digit revenue growth and positive adjusted EBITDA. We forecast revenue growth of 9%, 22%, and 28% for 2020 to 2022, and we project adjusted EBITDA declines in 2020 to reflect public company cost and the pandemic, but growth at over twice the rate of revenue for the following 2 years. We expect benefits from operating leverage, low-cost tech employees, cost volume discounts as the company expands, and margin improvement from new offerings and geographies. Over the long term, we believe the company can grow revenue close to 30% with even faster bottom line growth. His price target for the stock is $22, and there is one other analyst that also covers the KLR stock. And they both come in with a buy rating and an average price target of $22.50 for about a 38.8% potential upside over the next year. Now, unfortunately, Alan does not boast any stars as an analyst here on TipRanks, but our other rating does come in from a 5-star analyst, Michael Lattimore from Northland Securities, with a $23 price point for about a 40% potential upside. The second company on our list today is Vista Outdoor. They trade under the ticker VSTO and are currently at about $33.78 per share. Vista Outdoor is a sporting goods company with 40 different brands in 2 main divisions, outdoor products and shooting sports. Their shooting sports account for about $1.2 billion in sales and include some popular brands like Federal, Remington, and Bushnell. And their outdoor products are for about $0.6 billion in sales, and this includes Bushnell Golf, Camp Chef, Camelback, Bell, and Gyro. Some of their key drivers and recent highlights have been the acquisition of 2 industry iconic ammunition brands, plus new product introductions and brand portfolio strength. They saw a 35% sales growth fueled by new products and resurgence in outdoor activities this past year due to the pandemic. Their shooting sports has seen growth of about 120% year over year, and their outdoor products 35% year over year. They have a solid presence of market share in each product category, but especially in hydration packs, golf EMDs, helmets and accessories, and domestic commercial ammunition. Between their leading brands, large growing market, profitability upside, and proven management, Vista Outdoor presents a unique opportunity to invest in a company with significant upside potential. Covering the Vista stock for B. Riley is 5-star analyst Eric Wold, and he sees several avenues for continued growth by Vista. He's impressed by the growth in firearm and ammunition sales and by the price increase for products in both the outdoor goods and shooting sports division. Given our expectation that the increased industry participation numbers for both outdoor products and shooting sports during the pandemic will represent an incremental tailwind for the VSTO stock in the coming years, beyond the impressive production visibility that has been created by depleted channel inventory levels, we continue to see an attractive setup for baseline growth. Vista stock definitely has a bit more coverage than our first one, as there are 9 current analyst ratings. And the stock comes in as a strong buy. The average price target is $36.78 per share for about a 9% potential upside. But some of those price targets are a couple months old, and so actually bringing our average price target down a bit, whereas the most recent ones within this last week, we're seeing between 18 to 27% potential upside. And the third company that we're taking a look at today is Textainer. They trade under the ticker TGH and are currently at $21.97 per share. Textainer is a billion-dollar company that buys, owns, and leases shipping containers for the cargo industry. Textainer has operated since 1979 and is one of the world's largest lessors of these containers. They lease their containers to over 250 customers, including all of the world's leading international shipping lines. And they're now also one of the largest sellers of new and used containers, with annual sales in excess of over 140,000 units. They operate through a network of 14 offices and 500 depots covering all time zones and major trading centers over the world. Dry containers are the standard and bulk of their operations, but they do also offer refrigerated, special containers, and tanks. Looking at their last quarterly results, they did see a positive growth in all sectors from the prior year's quarter, and especially 46% growth in their adjusted net income. They've seen significant improvement in performance and outlook, with improved lease rental income, EBITDA, and net income, primarily due to fleet growth and higher utilization. Their utilization increased due to a surge in container demand and is averaging at about 96% for the quarter and is currently at 97.7%. They boast a strong balance sheet with stable cash balance of $234 million and ample availability in their debt facilities. Looking at Textainer for B. Riley is analyst Daniel Day, who is deeply impressed. He sees this company as lowest priced among its peer group with a strong market share in a competitive industry. He writes that we believe TGH is an underfollowed, misunderstood name that is ideal for the portfolio of a deep value investor looking for cash flow generative names trading at a steep discount to intrinsic value. With new container prices at multi-year highs amid a resurgence in container shipping, we expect upcoming earnings results to be positive catalyst events for TGH. On that note, the next earnings report date is expected to be on around February 18th, but we're still waiting for exact confirmation. Now, Textainer may be a bit more of a gamble as it does only have that one analyst rating, which does come in as a buy with a $31 price target, which would be about a 42% potential upside. So definitely some great room for growth there. With any of these 3 companies though, make sure you are doing your own research and due diligence before making any investment decision, and make sure it does fit into your portfolio along with your risk tolerance and time frame. Now you guys know I always love hearing from you, so let me know your thoughts on these 3 companies, which one catches your eye the most, and what other growth stocks are out there that you think are trading at a great value right now. Make sure to leave your thoughts down below in the comments. If you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a fantastic day, and cheers.